Hey everyone. On Chipstock Investor, we talk a lot about small cap stocks and how we use a basket approach of at least a couple of dozen of stocks to add to our portfolio with the idea that many will not succeed. We choose stocks that we think have a high likelihood of success, but unfortunately, with small cap stocks, that just isn't always the case. These are three small cap stocks that we will not be adding to our portfolio anytime soon.
Yes, that's right, Casey. We explained almost exactly a year ago why we were taking a hard pass on Indie Semiconductor, Navitas Semiconductor, and Wolfspeed. We talked about these stocks more than just once a year ago, but I'll share this with all of you, dear viewers. If you're trying to understand our viewpoint on these three companies, we think these are three crucial videos where we explained our rationale in depth as to why they weren't going to make the cut for us in our small cap basket. We'll link all three of these videos in the description below so you can find them if you want to review them. We're not going to get into all of the nitty gritty on these today for the sake of timing.
This episode is sponsored by our friends at public.com. Are you dissatisfied with your savings account? Check out public.com.
Public.com has just launched its new high yield cash account, offering an industry leading 5.1% APY. There are no fees, no subscriptions, no minimums or maximums, just 5.1 interest on your cash. You can transfer or withdraw cash as often as you like, and you get up to $5 million in FDIC insurance. Grow your cash at an industry-leading 5.1% APY with a high-yield cash account at Public. Go to public.com to learn more. But before we kind of update and refresh our rationale on these three things, Casey, we often say it is definitely a good habit for investors to say no more often than yes to small caps. Like you just said, Casey, most small caps, statistically speaking, are just going to simply underperform the market at best over the long term. So if you have a process that leads you to say no, the answer is probably still going to be no to that same stock later on. If you're looking for a long-term pick, ideally one that you can buy and hold indefinitely, the small cap stock you said no to before is still going to be no later on. It's like that pop song. If you didn't like it at its peak popularity, you're probably not going to like it 10 years, 20 years down the line.
I don't know. Hit Me Baby One More Time has really grown on me.
Is that your guilty pleasure, Brittany? Okay.
No, definitely.
Okay. Back to semiconductors. We're going to start with Indie Semiconductor, but let's kick this off with a look at our semiconductor end market table that shows where we're at in the different cycles, because this is something that we didn't talk about last year when we said we were passing on Indie, Navitas, and Wolfspeed. Last year was actually the peak for auto, industrial, and power chips.
Yeah, exactly. Ever since last summer, the auto and industrial market has been on a downward spiral. We haven't seen the bottom yet. Many companies are indicating during their earnings reports that they haven't quite started getting out of that bottom yet.
So if you're looking at this compound problem for businesses like this, businesses that maybe had a less than perfect business model, not actually operating from a position of strength, and then added to that, you now have an industry downturn for their end market, their customers. What you really need is a quick turnaround to justify a purchase at these levels. And as we've been discussing here as of late, after those Q2 updates have rolled in from a lot of the other companies, for example, like On Semiconductor, one that we do invest in the auto and industrial and power chip space, they've indicated that the recovery that is in the early innings, that's in the early stages, it's not going to be a really fast snapback. It's not going to be like that hockey stick shaped recovery. It's going to be more like a gradual L-shaped recovery, the bottom line. So that's not a good thing for these three businesses that really leave a lot to be desired on the business model front. Let's get into the specifics of each individual business, because we get it. We have been getting some fair questions on this, random comments on, say, an NVIDIA video asking, what do you think of Navitas Semiconductor? We understand it's been a year. The stock price is a lot cheaper than it was. And it seemingly makes sense. You would want to buy a business when it's down and seemingly out. But let's walk through this and talk about why we're not simply going to buy these because the stock is cheap. That's not a strategy that we subscribe to.
We'll start with Indie Semiconductor because this is one we actually did have in our portfolio, but we sold out of that position in early 2023. You can see that their balance sheet and free cash flow has deteriorated since then. Cash and equivalents has dropped, long term debt has increased, and free cash flow has decreased as well because of multiple merger and acquisitions. Indie Semiconductor also has a pretty complex business structure that we talked about in December of last year. We're not going to go into all of that, but Indie does have a subsidiary in China called Wuxi that complicates the business a bit. Catch that in the December video that we linked in the description, but it is important to understand that part of the business structure to understand this whole business model for Indie.
And let's briefly look at what they said to expect as far as outlook in Q3. Now, this can be a little sketch when it comes to reviewing the guidance for upcoming quarters, because in the actual press release, it looks somewhat positive. They say 0 to 5% growth, 2.5% at the midpoint. The problem with that is this guidance is sequential, quarter over quarter, not year over year. So you actually have to go into the earnings call to decipher what they're actually talking about, to decipher that they actually mean 0 to 5% growth on a sequential basis. So that means that for the third quarter, the outlook is actually just $53.7 million in sales, which is down significantly, over 10% at the midpoint from last year. So this is what we called out as being the problem, where the growth trajectory has run its course via acquisition. The days of early money are done. And now Indie is dealing with this industry downturn just like everybody else. And in addition to the revenue now being in contraction, you also just mentioned the complex shareholder structure. And because of that, there's large increases year over year in share count. Dilution is an important factor to account for when you're looking at a business like this that has grown via acquisition. So in addition to the revenue in absolute dollar terms contracting, when you actually account for the rising share count on a per share basis, Indie is actually shrinking a lot faster than it would appear, a lot faster than the 10% at the midpoint of guidance. This one really is quite the mess. It's still a hard pass for us.
Let's shift to Navitas. And on the surface of this one, the balance sheet doesn't look so bad. The company actually does have cash on their balance sheet and no debt, but free cash flow is still in the negative. The company is still not profitable.
Yes, this is true. However, at some point, they are going to have to raise more cash because of that negative free cash flow. They're spending more money than they're bringing in. So at some point, they are going to have to either issue debt to get some cash to fund their operations, or they're going to have to issue and sell more stock into the market. So much like Indie Semiconductor, there's possibly a big dilution problem happening here for Navitas. There's also a significant amount of stock-based compensation going to management. This is another pretty ugly one if you're trying to figure out the business is doing on a per share basis. And also like Indie Semiconductor, the guidance isn't so great for this one, is it?
No, it is not. On a year over year basis, you can see that the revenue is expected to be around flat with the Q3 revenue of 2023 at $22 million. And that cash continues to dwindle, and there's not much to make up for it.
A lot of you took issue with us on this one. Navitas, in their own description, is a pure play on gallium nitride and silicon carbide wide bandgap semiconductor design. However, most of the sales up to this point have been, you know, pretty simple. Therefore, things like these chargers, smartphone chargers. Okay, cool. That's fine. Pretty low value stuff. In addition to that, most of these little gallium nitride and silicon carbide chips for chargers, they're not actually like full blown commercial production sales. They have a couple of customers that are testing the chips in their chargers. It's nice to talk about companies like Apple that could potentially use these wide bandgap power chips in the chargers, but again, not mass production. That's why the revenue is minimal and the losses are so steep. This one not looking pretty, another hard pass for us. Maybe at some point, Navitas gets some more commercial production in automotive and charging. And now data centers, they're talking about data centers, of course, and supplying power chips to them. This is just not a business that is actually producing much in the way of economic benefit at this point. It's a pre-revenue company. I think it would be fair to categorize them as that.
So what about Wolfspeed? Wolfspeed calls themselves the only silicon carbide pure play in the market.
Yeah, we debated making this video until after Wolfspeed earnings on Wednesday, the 21st. Maybe we'll explain why we decided to just do this ahead of earnings anyways. One positive thing here, Casey, that we should maybe mention right off the bat, the balance sheet actually looks like a normal business, a normal manufacturing business. So there is that. They have 2.5 billion, 2.6 billion in cash. They do have a bit of rising debt, almost 6 billion in debt. However, free cash flow is still negative. But if the automotive and industrial markets do return to growth, perhaps in 2025, surely this one is going to rebound in dramatic fashion.
You might think that, but unfortunately, probably not anytime soon. That new Mohawk Valley fab in New York is currently at 20% yield capacity and expected to be at 25% capacity by the end of this year, but still not even close to cranking out chips at full capacity.
Yeah, which is a big problem if you're trying to turn a profit, which is kind of what you want. If you own a business, you want it to turn a profit at some point.
That's what I keep hoping for.
This is another one on a year over year basis. That outlook at the midpoint for Q4 fiscal 2024 revenue, that's going to be reported on the 21st in just a couple of days, $200 million. It's another year over year decline, more than 10%. So it's getting hit pretty hard, just like everybody else that plays in auto and industrial and power chips. And because of that very, very low fab capacity problem you mentioned, Mohawk Valley just at 20%, the losses are going to continue. Wolfspeed is going to be deep in the red, and that creates for a very uncertain future for this business. And this is one where I think so many people just underestimated how expensive and how long it takes to build brand new fabs, brand new chip manufacturing facilities, let alone a couple of brand new chip fab facilities. These were greenfield projects for Wolfspeed, meaning they were just raw land when they started, versus onsemi, which went with the brownfield approach. They had actually an existing fab that they upgraded and retrofit for silicon carbide production. So for Wolfspeed, last time we covered it, I think it was still close to 10 times price to sales, or maybe it was like 10 times enterprise value to sales. Now, as of this recording, nearly 5 times expected enterprise value to sales. This is still not a cheap stock. Even though the stock price has fallen precipitously from those highs, the company's still losing money. And really, this could be said for the other two companies as well, Indie and Navitas. Don't look at the stock price. What's the future expected profit profile of these businesses? And for all three of them, profit is actually expected to be negative. The actual expectation is a loss for the upcoming year. So all of these price to sales and EV to sales metrics based on the future, not really a cheap price, right?
That's really what you have to ask yourself when you're deciding whether or not to add a small cap company to your basket of small cap stocks. As far as we're concerned, these three companies don't meet our criteria at this point in time to add to our portfolio. There's so many more options out there that we Bitcoin attractively valued, and the business is in good shape. These other companies that we find more attractive have a full gas tank and they have a very, very clear destination that they're headed towards. Wolfspeed, Navitas, and Semiconductor, not so much. Maybe they do have a clear cut destination, but the gas tank is running on fumes. Or maybe they have a full gas tank with lots of cash on balance, but no clear cut direction. That's the problem with the price to book value as well. And Nick, maybe you can walk us through what this is exactly. I needed an explainer on this and how we use this valuation metric.
It's more of a classical value metric for a company that has lots of physical assets. It doesn't work so well when you're dealing with tech stocks where there's a lot of IP, intellectual property, patents, trademarks, things that don't have a hard, tangible value. This can be problematic. And still, the thing about price to book value is it also changes based on the future cash flow expectation of those assets. This is one that has come up as of late, specifically around Intel stock. We think maybe we're hopefully getting ahead of the curve just a little bit here because someone is bound to say, hey, look, if the price to book value of these three stocks gets to one or less than one, it's a value. And maybe it's a great buy. However, for the long term, if you're looking to buy a company that ideally you can own for many years, and it can be a profitable part of your portfolio for many years, price to book value is not a good basis for making a decision like that.
Maybe some of our viewers will have to agree to disagree on this point, but if you want to have more of a discussion on this, check out our Semiconductor Insider. You get access to our Discord channel, which is only $5 a month. All of our show notes, video notes, and live Q&As are over on Discord.
And speaking of Discord, that is now the exclusive spot where you can find all of our articles, all of our coverage of our portfolio and the stocks that we follow and that we analyze. We're amassing quite the library over there. So that's where you can find all of that. We talk a lot about our small cap basket of stocks. And of course, many of you know that we're not perfect. We also pick some pretty bad small cap stocks too. We thought the lithium market was reaching some sort of bottom earlier this year, back in the spring. That hasn't worked out. So we've been talking about that over on Discord as well regarding Arcadium Lithium, Albemarle, not a small cap stock, but at this point, definitely headed in that direction. We said we would maybe do a video on lithium later this year in the autumn, but if you're interested in our thoughts on that right now, we have lots of coverage over on Discord.
Make sure you subscribe to the channel and check out our affiliate links in the description below. We have some cool stuff down there. We have our sponsor with public.com, as well as some free stocks with Momo that goes until the end of August. Check that out below, and we'll see you again soon at Chipstock Investor.